Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Curt Long, the chief economist for NAFCU, the National Association of Federal Credit Unions. This was a great conversation. For reference, we recorded it on July 18th because this is a little bit more timely content than many of our podcasts. We really talked about the state of the economy, a recent CPI print, actually a little surprising to the positive generally. So we talked through the implications of that for interest rates, for auto markets, for housing markets, where we think the economy is going and how financial institutions can adapt to the world as we're finding it. So it's a really interesting conversation. I always love diving into data on the economy and details. It's not an area I follow sometimes as closely as I feel like I should. And so getting to talk to an expert, always fun. And I think really insightful for anybody thinking about how the state of the economy and the response of the Fed maybe impacts the decisions they're making as a financial institution. I think it's a great set of information for that. So please enjoy this conversation with Curt Long. Curt, thanks for joining us today on the podcast. I appreciate you making the time.
Yeah, excited to join you, Jeff.
Now we should give the date. We're recording this on July 18th because I feel like some of the podcasts are kind of evergreen and ones where we talk about economics are maybe a little less so. So maybe I'll start with that caveat and then ask you a version of my standard opening question, which is like, I think most people didn't grow up dreaming of being in the banking industry when they were kids, and probably not economists at credit union associations. So tell me a little bit about your path to where you're at today.
Yeah, sure. It's definitely wasn't a straight line to get here. I actually grew up in Texas and first got my first degree in accounting. So I gave that a shot for a few years and eventually learned what most people learn much earlier than I did, which is that accounting is a fine profession, but not really for me. And so for some reason, I got it in my head that econ was might be a more interesting path. And so went back to school, got a degree in that, and then moved out to the Washington, D.C. area after school. And that's where I hooked up with the credit union movement.
Love it. And how long have you been in the credit union movement then? I've got to do the math.
Yeah, it's been about 10 years. So joined NAFCU, right after the financial crisis. So it's been a interesting kind of an interesting business cycle to follow over that span.
Yeah. So I find like in some ways the most fun kind of interview, in some ways the hardest for me to prepare for, because you never really know what you want to talk about until the day of, because the ground keeps shifting underneath your feet. And I think the thing on most people's minds right now, the latest bit of data was the latest CPI print, which came out recently and was, I think pretty positive overall. Can you give me your take on what we learned from that and how people are reacting to the kind of the latest set of inflation data?
Yeah, I think it was a really positive report. Positive in the sense that it seemed like the inflation number was nice and low, right where we wanted, and in particular, when you got under the hood, we saw some real deflationary trends kind of developing in areas where we've been expecting them. So two in particular, one being automobiles. And so, autos were obviously a big source of inflation on the ride up. And then now we've sort of been waiting, knowing that at some point that would probably reverse course. We've gotten, I think just today, actually, we got new data on auto production. And now we've had 3 months in a row of much better numbers on the production side than what we've been getting. I think actually the June number was down a little bit, but still roughly in line with where we were pre-COVID. So, there's still a pretty big deficit in terms of the number of autos that are still missing from, what didn't get produced in the last couple of years. But I think production is improving. As that happens, you're going to start to see some of the air taken out of, some of these car prices, both on the new and the used side. The used side actually is where we've seen a ton of inflation, just because there haven't been any new vehicles
to buy. So
yeah, so that's one area where we saw much better numbers last month, and hopefully that's a sign of things to come. The other is housing, and housing is sort of a similar story. We've been waiting, and it's sort of by construction, the way that the government statisticians develop their estimates of housing inflation. It sort of operates at a lag. So what you see happening in the market, when you see rents starting to cool down, we've seen that for several months now, but it takes time for that to work its way into the official stats. And so it seemed like we started to get some of that last month. And the good news is that because it happens on a lag, there's a lot of certainty about what the path forward is on the housing inflation piece, at least. And so I think things are looking good from that standpoint as well.
Interesting. Yeah, it's always interesting to dive. I always get these takes from our CFO on the very detailed sets of numbers inside of the gross inflation number. And I think there's a lot of important information and insight in there. I want to dive into each of these areas. You talked about autos and housing in a little bit more depth. What do you think the autos, we'll start there, says to lenders? Because one of the things I've heard some concern about is as prices come down, what does that mean for loan to value in terms of what I underwrote to, where I'm going to stand, and do I need to be? I mean, a lot of people were nervous about lending on autos when prices were high. Going, I mean, the value of that collateral is probably not going to stay where it's at compared to the prices things were selling at a year ago. How do you see that playing out and impacting lenders moving forward?
Yeah, I think that's a valid concern. I think you've heard a lot about worries about residual values for a while now, and I think especially on the lender side, we started to see that maybe middle of last year, starting to sort of pull back a little bit. We saw some of that evidence come through from the Fed does this quarterly survey of senior loan officers, and I think that we saw some evidence of that there. Credit unions too, I think, are starting to get a little bit more conservative in terms of the amount of lending they're willing to do on the auto side. And I think too, the inflation numbers kind of feed into this in a sort of a different way as well, which is, in terms of what this means for the rate outlook. I think a lot of concern when inflation was running really hot. I mean, it's still running pretty hot, but maybe when recessionary concerns were higher, that rates could come down because we were entering a recession, right? So the Fed might have to cut rates because growth is negative, and so maybe there was a rush to the door to get those loans in while rates were higher. But now, as I think some of those inflationary worries have subsided a bit, I think with that, some of the recessionary concerns have subsided too. And so I expect I think the rate outlook, I expect rates to remain sort of elevated for maybe a longer period than maybe some were concerned about, because I don't think I don't think recession is right on our doorstep.
Interesting. And the market seems to agree with you, at least judging by the color in the stocks app when I open my phone. It feels like people are more optimistic about the possibility of a soft landing or avoiding a recession than they've been historically. Is that the sense you get from the markets generally, that people are optimistic about not only the rate environment, but what the economy holds for us for the next period of time?
Oh yeah, I think so. I think you've seen this among a lot of economists too, not just the markets. A lot of economists are revising their recession probabilities too, and yeah, I think you see that play out in both senses. So it'll be interesting from where I sit to see how the Federal Reserve deals with that. They have a meeting upcoming at the end of July where they're probably going to raise rates again, but now I think the narrative has shifted a bit to where we expected that to be maybe the first among several more rate hikes, maybe not in succession, but we would still have to get several more. Yeah, but now I think with clear signs that inflation has started to cool just a bit, maybe the Fed can be a little bit more patient. They're probably going to raise rates in July, but I suspect the doves are going to push for, they're going to say, okay, we'll give you the rate hike for July, but we're going to hold rates steady in September, and then we'll circle back in October. And if we don't get a massive, change from where things seem to be headed right now, I think July could be the last rate hike.
Wow, I'll put that as your bold prediction for the episode, because that's That would be interesting. Certainly not where we thought we would be just a couple of months or even a couple of weeks ago in terms of what the expectations were for the rate environment moving forward. How do you see that impacting the housing sector? Because it's interesting. There's, when rates go up, all of a sudden the refi business that a lot of people had been living on from a banking point of view, from a lending point of view, was like, well, we can't really refi when as rates go up. There's not a lot of refi business to be had. But it seems like often buyers are waiting for rates to go down to go out and make larger purchases. Do we expect to see that? How do you think the kind of rate environment and the shifts in that impact the housing sector, both in terms of sales and in terms of the loans that maybe credit unions, banks are looking to make and are able to find in the market?
Yeah, I think in terms of housing, on the buyer side, I'm not sure mortgage rates have much room to come down here in the near term, just because, one of the things, at least weighing modestly on the longer end of the curve, was the idea that a recession might be in the works. And so as those recession probabilities have been sort of reined in, some of those downside concerns are abating. So, here just in the last few weeks, even though I think expectations for the short end of the curve have changed a little bit, we haven't seen that really play out on the long end as much. So, unfortunately for, a lot of credit unions rely heavily on refi activity, but I'm not sure I see a lot of refi originations here at least in the near term.
Yeah, it didn't feel like we're going to be down to a world where lower rates are driving refi. And it's always important to remind people about the longer sweep of history. We have so many young people that I talk to, and they find these rates, they're going, oh my God, rates are so high. And I go, well, I mean, 2% and 2.5% mortgages is not exactly the standard across the sweep of history. And even where we're at now is not really compared to the 80s or not exactly super high interest rates. I mean, certainly we've experienced much higher rate environments than we're in today, even as the Fed's been raising for a while.
Yeah, talk to your parents, right? They'll have some good stories about the first mortgage loan they got.
Yeah, mortgages that sound more like credit card rates to us these days than mortgage rates.
Right, yeah.
All right, so that's taking housing. So one other thing I wanted to ask you about was, how is the environment? I think as we've seen inflationary pressures, the fear of recession, the question was like, how is this going to play out in the performance of credit, particularly consumer credit? Are we going to see deteriorations in credit performance? We've seen bits and pieces of that, but not, I don't think, a broad sweep of like massive deterioration broadly. How do you think what we're seeing now changes the outlook for what people are expecting from credit performance for existing portfolios over the next period of time?
Yeah, I think, at least on the credit union side, we have seen a bit of an increase in delinquencies. And I think that's consistent with what other lenders are seeing as well. It isn't clear to me, though, that things are going to continue that way. I mean, what we've seen so far is, delinquency and charge-off rates sort of come back to where we were entering the pandemic, more or less. Obviously, there was the big drop, in the first couple of years after the onset of the pandemic, and things have sort of reversed course. But, is that just sort of coming back to equilibrium, or is it going to just continue to rise? I think, my leaning, this is more my gut, is I think we're okay. Part of that is just because I think I've had a more optimistic view that we can get the soft landing in the economy than maybe others have had. And that does seem to be the more and more the prevailing view. And so if we can avoid a recession, I mean, unemployment rate is still below 4%. And it's just hard to squeeze a lot of, credit problems out of an economy where so many people are working and still getting reasonably good wage growth.
I think that makes sense. And I think people also underestimate when they see the kind of rapid deterioration. I mean, not massive, but it came pretty quick. And just how big the government stimulus was and how quickly it stopped, and the kind of that was not a sloping curve. That was a big discontinuity in terms of what people had available, and it did kind of push us back to what the world looked like when there wasn't government stimulus or a depressed economy due to a pandemic that was keeping people in their houses and stopping production and stopping services from being delivered and all that. So it feels like something more pre-pandemic normal is what we should be looking for. But fingers crossed, because it's always people always like to connect the dots and draw a line, and and it certainly points in one direction right now. So what's your advice when you're talking to your credit union members these days? Like, what are you telling them now? I'm curious how that's changed over the last couple of weeks, because as I said, we kind of have had some good news. We've had a different time. What's your advice to them on how they're preparing for both? Sometimes it's like, am I battening down the hatches for tough times, or am I ready to start lining up my opportunities to take advantage of good times? If I think things are going to be more stable, I want to go out and figure out, how do I grow, how do I drive growth, as opposed to how do I limit my exposure to loss. Where are you at, and what are you hearing from them in terms of what they're doing to prepare and how you're advising them?
Yeah, it's interesting. I think as conditions have changed, I've sort of had to tailor my message, even though we get a lot of stuff wrong. I think in general we've sort of been right about how at least the first half of the year would develop. I think our position was, despite all of the problems and all of the risks, the labor market is so strong right now, and that's going to buoy the economy for long enough to get to the point where we start to see some disinflation. And I think that's sort of what played out. So my message to our members has been, don't be so pessimistic. I think a lot of times their instinct and what they're hearing from a lot of other folks is that recession is inevitable. A reasonable position to take, by the way, given what the Fed has done. Going from 0 to 5% almost overnight. I certainly sympathize with anyone who had that view. Now that we're at the position that we are, where people are, I think, a bit more optimistic about getting the soft landing. Now I find myself starting to worry a bit more. Maybe it's just human nature. We all need something to worry about, right? So, I think the risks that maybe the number one risk that's out there that I don't see people paying maybe enough attention to is, okay, so, the labor market is still really good. Inflation is starting to subside. That means real incomes are going up now, right? I think actually the Wall Street Journal just ran a big article on, real wages are now positive again after being negative for quite a while. So with that comes a little bit more spending power on the part of workers and consumers. And so, it's certainly not out of the question that we could get a reemergence of inflationary pressures. So I think that's actually is the bigger risk than an immediate recession, is that we get inflation coming back to life, sort of like the bad guy in a horror movie, right? And the Fed actually does have to raise rates further to address that.
Interesting. Now, you bring me to something that has always been curious to me, and we talked about this in the beginning, which is it seems like we have this long-term inflation target that the policyholders are trying to hit around 2. We often run below it. And then when we go above it, the sense is like, no, you're not allowed to be above it. We must be below it. And, I'm sort of a numbers guy. And for something to average out, you have to have equal time, at least time-weighted delta between when you're below it and when you're above it. And yet we don't seem to be comfortable being above it as long as we are comfortable being below it from a target point of view from inflation. What's your sense of that? Is that just like a political reality that can't change? Is there, any movement to really, from a policy point of view, be honest about the desire for what the average should be and live to a long-term average, which might mean periods of higher inflation following periods of really low inflation over time? Like, how do you think about that? Because it's always been interesting to me that it feels like as soon as you clear the average, you're in like the red zone and people are nervous and trying to fight it back down, which feels counterintuitive to the nature of an average, a target for an average.
Yeah, so that's a super interesting question, and I'll try not to let myself go too crazy here, being a nerdy economist on this question. But the Federal Reserve has also noticed this asymmetry that you've described, where for the better part of a decade prior to the pandemic, we were below the Fed's 2% target, and yet no one seemed to be too bothered by that. There wasn't too much effort made to try to get back up to the 2% target. And yeah, things seem much different when you're above the target, right, than below it. The way that the Fed they did make some measures to try to address this asymmetry. It was kind of interesting. I think if they had it to do over again, they might not have done so. It was actually right before the onset of COVID when they announced a change in their framework. So they called it FAIT, FAIT, Flexible Average Inflation Target. I think if I still remember that acronym, but the idea was that they were going to do just what you suggested, and average the inflation over a period of time, so that it was sort of the idea was there would be a payback period. If you spend some time below the target or above the target, then you've got to shoot to go on the other side of it so that over time it averages out. Now, as I said, the timing of this couldn't have been worse because
maybe the rest of your fortitude to deal with the new policy approach.
Yeah, that's right. So, it seemed like the obvious motivation for this was to convince people that they know that we're recognizing and dealing with this asymmetry. So we're not going to spend the next decade being below 2%, right? We're going to hit that target over time. And of course, we all know what happened. Things did not go according to plan. And so now that we've spent quite a while well above the Fed's 2% target, I think the natural question is, does that mean we have to be below target for who knows how long once we get inflation back under control? And I think the Fed, not in so many words, has said, you know what, just forget all that. So I think once they get back to 2%, they're just going to say, hey, we're starting from new right now. And who knows, maybe they'll keep the flexible average inflation target model going forward. But I don't think that's going to cause them to feel like they have to spend time under the target.
Well, I mean, theoretically, I could tell you the opposite, which is you should be allowed to come back down slowly because you've got. I mean, if you'd set that marker 5 years ago, you'd have a lot of buffer to be over right now to average into where you're happy. You go, yeah, we don't need to be back there tomorrow. We need to let it play out. But it'll be interesting to see if that plays out because it's always. I do worry too that it's a nice framework, but politically the pressure will always be. There's very little pressure to increase inflation. Particularly when you're at super low rates, there's not that many tools to drive inflation up. And then, but nobody likes to see inflation high. That hits everybody's pocketbooks, and there's going to always be political pressure to do something to change that scenario. So I don't know that the incentives for pressure are aligned equally on both sides of that line. So I'm not sure you can really ever solve that problem with just a policy approach. So I'd love to believe that you could.
Yeah, I think that's probably the more parsimonious answer, right? Is that, no matter what the Fed's framework is, the political realities are what they are. And we've seen that. We've certainly seen that as clearly as we could during the last few years, which is, consumer sentiment measures are in the tank, business sentiment indices, the same thing. People don't like inflation. And if you needed to be reminded of that, then now you know.
A couple of years of inflation will remind you that people really, really don't like it when inflation runs hot.
Yep.
Well, Curt, this has been a fascinating conversation. I appreciate your joining me today for it. I do have 3 closing questions I ask everybody, and I'd love to throw them at you right now. They're totally different than the last 20 some odd minutes of conversation. But I think equally interesting. So here they are. The first is, what's the best piece of career advice you've ever gotten?
I remember when I was 7 years old and my grandfather asked me what I wanted to do when I grow up. And he said, just do what you love and you'll never have to work a day in your life. And I felt like, all the best decisions I've made with respect to my career have been when I sort of didn't worry too much about where things were headed and just wanted to work on interesting subject matter and interesting jobs. And, that's served me well.
All right. I like it. Little Steve Jobs from your grandfather. Maybe Steve Jobs cribbed your grandfather when he was writing his speech, and he'd heard that one before. My second question, which is it may be interesting given the last conversation, but what's the best advice you've gotten about the general consumer banking segment? I hate saying banking to credit unions, but I don't know that credit unioning is like a sector indices, so I use it. But what's the best advice you got about that industry in general?
Maybe just because when I started, it was right after the financial crisis, and so I think the advice I got, not in so many words, maybe, but when banking is good, it means it's boring. When banking is interesting, that means something's going wrong. And so, a lot of times I find this in our own work is you always want, consistent with my previous answer, you want to find the most interesting corners of the market. And but sometimes that's where those are the most dangerous corners, right? So sometimes boring is good.
Sometimes boring. That's actually really interesting advice. It is fascinating how many problems in the banking industry historically have come from trying to get away from the boring in good times. Like, the basic taking of deposits, lending of money, making of net interest margin can feel a little boring when things are stable, and then we reach for something else, and it's usually the something else that causes a problem when the next cycle turns. Interesting advice. And my last question.
We found that out in March, right? a few banks tried to get a little interesting, and didn't work out so well.
Yeah, you can. Sometimes, what's the phrase? Too clever by half. Banking is a pretty straightforward industry, and when you're too clever by half, sometimes I just go, I don't know that I see that. All right, and my last question: what's one bold prediction for the future? You've already said the last rate hike in July, so you can stick with that one. That's a pretty good answer for that question. But do you have any other bold predictions for the future? You want to stick with that one?
I think I will stick with that one, but I will, as a sort of caveat, I will say, a lot hinges on, of course, whether how the economy evolves over the next 12 months, and so that's sort of what I've been sort of thinking about in my own free time, is how this might all work out. We've seen the Biden administration really latch on to the idea that things are looking better right now. They're throwing around the word Bidenomics quite a bit lately, with the hope and expectation that things are going to look pretty good a year from now. And so, my expectation is that they will. But even though I think the risk of recession has receded, I do think there's a real risk of inflation coming back. Maybe next year. And so if that happens, I suspect that's going to be probably show up in those consumer sentiment numbers that we've been talking about, and that could be a real problem for the current administration.
Yeah, that's it's interesting you said. I'm always reminded that I was in a meeting with a board of a financial institution right before the pandemic hit, and they asked about AI models and credit and how you think about different scenarios. And I go, well, barring any kind of global macroeconomic event that's kind of unforeseen, we take a lot of stuff into account. And then they, and a few weeks later I went, yeah. So when I said there were some things we don't have in the model, like this is definitely on the list. This is definitely on the list. So, you've always got what you think will happen. And then the world sometimes has different plans and throws you a curveball for those predictions. But I like that one. For our own sake, I hope you're right on both of those. I like both predictions. So we'll have you back sometime and see how they hold up. But Curt, thanks again for making the time today. This was a real pleasure, and I learned a lot, and I appreciate you making the time.
Thanks so much, Jeff. Enjoyed it.